Good morning and welcome to the Kill and Go podcast for Friday the 13th of March. It's been another week where the US dollar has been pushing markets around. We've seen a real acceleration in the trade-weighted index of the US dollar following that strong jobs number on Friday. But we saw a very weak retail sales number yesterday where we came in at minus 0.6% against 0.3% expected. And that was a surprise for markets because we've seen a real wage increase because of the lower oil price, but that hasn't been feeding into more spending. So consumers have actually been saving that. Just looking at where we feel the US dollar goes from here, we feel that potentially it could have a little bit of a pause after recent strength, which would be actually supportive to US markets. And that's because history suggests going into a rate rise, you get 6 months of appreciation. Then post that rate rise, you tend to get a 6 months where it depreciates. So it's better to travel than arrive for that particular currency. That might be a sort of moderated in terms of the impact this time round because of the rather large interest rate differential between the US dollar, euro and yen, but we'll see. We're certainly seeing a monetary tightening in China as a result of the weak euro. And here we can see the RMB, which again, their trade-weighted index, you can see that that's moved quite significantly upwards in terms of strengthening since QE has taken off in Europe. And that's putting a little bit of pressure on the numbers in China. And this week we've seen some poor numbers from China. The retail sales number, again, falling year on year. That's really showing quite a negative trend. And equally, imports, despite that stronger currency, had a very bad print this week. So we're watching that pretty closely. The other key market moving event this week has been the Fed stress tests on the US banks. This is important because it clears the way for the big banks to start raising their dividends and starting to buy back more stock. We've been talking about this quite a lot recently, and here you can see the divergence in terms of performance between the S&P index and the S&P bank sector. So big outperformance from the banks there, and we expect that to continue. In the UK, we've just done a little bit more work on the UK constituents in terms of their balance sheets. And here you can see the core Tier 1 capital ratios of the main banks in the UK. And the big number to look at here is Lloyds, which has a 12.8% Tier 1 capital ratio. So they have a lot of room to increase the dividend payments and buyback should they wish to, significantly more than the other banks in the UK. At the moment, Lloyds are targeting a 50% payout ratio from sustainable earnings, and here you can see the dividend yield is expected to come in at 3.4% in 2015, rising to 6.6% in 2017. They say that that's actually the base level, and in the absence of compelling capital investment opportunities, you could see them paying near 70 to 80% of their sustainable earnings out in shareholder returns. So that would be a big driver for the Lloyds stock price. This week coming up, we've got a relatively quiet week. We've got Linde on Monday of the Killik stocks, and then coming through on Thursday, we've got Nike. As you can see from this chart, Nike has derated slightly since they last announced their results. So we've seen a reduction in the PEG ratio, which is the P divided by the growth rate, from 2.1 to 2. We're willing to pay that sort of relatively full PEG ratio because we think the earnings and the earnings growth potential are extremely strong and sustainable. However, within the sector, Nike has underperformed their main rival, Under Armour, and that's really sort of been more stark since the sort of late January, early February here. This level of outperformance from Under Armour has been in recognition of the two app businesses that they bought recently. So they're looking to create a fitness network, which is similar to Facebook's social network or LinkedIn's business network. And they can now, through their acquisitions, reach 120 million users. At the moment, these apps are marketing expense. They drive sales through additional marketing. But what they want to do is to create a network that has its own monetization potential through creating data that they can sell to connected users. Now, if you look at Facebook, Twitter, LinkedIn, on average, from that 120 million user start, for the next 4 years, they grew sales at a compound annual growth rate of 125%. Now, at that rate could deliver sales of between 500 and a billion incremental value to Under Armour. Nike has a similar sort of fitness network, and they have a more entrenched register user number of between 35 and 40 million. And we feel that they will compete with Under Armour in this space and deliver a similar sort of fitness network we think can deliver significant and similar sort of value to that stock. Just lastly, for the Cheltenham Gold Cup at 3:20, the boys are saying many clouds at 8-1. Thanks a lot. Have a good weekend.